Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals, in our 26th year in business. It's Tuesday evening, January 27th, and the title of today's audio blog is Catastrophic Pre-OFMC Drift Portends the Yellen Reversal Wednesday Afternoon. Well, yesterday's audio blog was titled Three Major Central Bank Failures in 1 Week. Do I hear 4 or 5? Regarding number 4, I was speculating that the long-awaited Yellen reversal would finally come Wednesday afternoon, as at this point there is simply no way to pretend the U.S. economy is recovering, and the Fed contemplating tighter monetary policy, even if done patiently or in a considerable amount of time. The fifth refers to the potential for the PBOC, i.e. the Chinese Central Bank, to depeg the yuan because the strong dollar is dragging it up and destroying its international competitiveness. I have no doubt both will occur, although clearly the Fed failure is more imminent, as less than 24 hours from now, Whirlybird Janet will be forced to comment on the economic state of the union. I'll get to tomorrow's Fed meeting in a second, but first I'm going to discuss some other topics, with the first being China itself. Yes, this morning it was reported that Chinese industrial profits plunged by 8% year over year, representing their largest annual decline on record. And this, a week after its fourth quarter GDP growth came in at its weakest rate in 25 years, even if it was supposedly a positive 7.2%. Of course, China's 7.2% GDP growth is as relevant as the US reporting 5.8% unemployment rate when the real rate is nearly 25%. To wit, not only is there a major cognitive dissonance between 7% GDP growth and an 8% profit decline, but Chinese PMI diffusion indices have been consistently below 50 for the past year. And for those not familiar with diffusion indices, readings below 50 depict economic contraction. Anyhow, today's Chinese data will only heighten pressure on the PBOC to depeg the yuan, which as discussed the past 3 days, I believe will not rise but fall against the dollar if left to trade freely. Such is the nature of the final currency war, where the only way to win is to destroy your currency, and with it 99% of your population. Which brings me to my next hellacious point, which is the utter collapse of U.S. corporate earnings caused by the surging dollar. Whilst the MSM and Wall Street have been busy propagandizing how the strong dollar was a result of a strong economy, I have been loudly screaming it was solely due to a flight to liquidity as global capital, fearful that the big one has arrived, are not buying dollars, but instead selling illiquid assets like foreign currencies in lieu of liquid ones. Like US dollars, treasury bonds, and oh yeah, physical gold and silver. Of course, while the dollars and treasuries will ultimately be worthless, gold and silver will be priceless and sometime soon, perhaps very soon, offerless. Frankly, it's hard not to laugh at those claiming the exploding dollar is a good thing, as while in theory this is the case, in practicality it causes dramatic global political, economic, and social dislocations. And oh yeah, exploding inflation for billions of global denizens. Putting in perspective, the parabolic dollar explosion to levels not only well above the 2008 crisis highs, but not levels not seen since 2003 is as much a quote good thing for America as collapsing oil prices represents a beneficial quote tax cut. For months, I have shouted from the rooftops that the surging dollar would destroy U.S. corporate earnings, and today the rubber hit the road when United Technologies, Microsoft, Procter & Gamble, and Caterpillar led a host of titans missing earnings estimates and reducing guidance for just this reason. And whilst Microsoft had one of its worst trading days ever, it was Caterpillar that stole the show regarding its ominous outlook. As not only did its earnings dramatically miss estimates, but its forward guidance was even worse. Not that readers of the Miles Franklin blog should be surprised, as we have continually highlighted the horrific sales trends Caterpillar has reported, such as year-over-year revenue declines for something like 22 straight months. However, throwing in the massive reduction due to currency issues, it couldn't be scarier what Caterpillar's results portend, particularly for both mining and energy expenditures, the former of which will exacerbate the massive production declines we have anticipated, and the latter signifying a dramatic decline in activity in a business that encompasses a third of all U.S. corporate capital expenditures. And as for Procter & Gamble, arguably one of the world's largest consumer products companies, its CEO was interviewed on CNBC while I was at the gym this morning as, quote, P&G sees significant negative currency impact, repeatedly scrolled across the screen. And by significant, let's just put it this way. We are just talking about the fourth quarter here, when the US dollar index was far weaker, averaging 88.1. However, in just the first 4 weeks of 2015, the dollar index has averaged 93.2, peaking at 95.5 yesterday afternoon before settling at 94.0 today. In other words, if you think U.S. multinational earnings were bad in the fourth quarter, just wait until the first quarter when not only will currency translations be far worse. This is exactly what I warned of in last week's most ominous quote of the year, in which I claimed that corporate lobbyists will put massive pressure on the Fed to debase the dollar. And oh yeah, last year's single most precious metal bullish factor imaginable, where I discussed how the massive volatility demonstrated in the terminal stage of fiat Ponzi schemes literally destroys business activity, particularly when central banks like the Swiss bank sabotage it further. And by the way, not only will first quarter earnings be catastrophically impacted by currency translations, but oh yeah, the catastrophic oil and commodity crash, which is just now starting to impact corporate decisions. To that end, even Jim Cramer got something right today when he said, the only conference call you'll ever need is Caterpillar. It is my gospel, my go-to call, and the source of my global outlook. And if today's massive durable goods orders plunge of 3.4% versus expectations of a 0.7% increase is any indication, let alone the PMI services orders component falling to a 7-year low, it won't be long before people realize why. All the way back on October 7th, I wrote that 2008 is back with one temporary exception. Of course, that temporary exception was PPT Goose stock markets masking reality, which more and more each day appear likely to be overcome by the unstoppable tsunami of reality. But hey, it was also reported that consumer confidence soared to its highest level since 2007, i.e. just before the biggest financial crisis of our lifetimes. Such drivel is Washington Wall Street propaganda at its worst, and frankly is so ridiculous it's hard to believe anyone seeing it didn't at least chuckle, and more likely laugh out loud. Next, we have that little old thing called Europe, where the aforementioned 3 historic central bank failures occurred in the space of just 10 days. In Switzerland, it appears the SNB was back in the franc suppression game again today, only to watch it again fail. And as Bill Holter has written incessantly about, the hideous losses from last week's unexpected franc revaluation are just now starting to come into view. Recall, for instance, that despite Austria's supposedly conservative banking system, its largest bank failed earlier this year and was forced to be nationalized, Fannie Mae style. Well, today the bonds of Austria's third largest bank went into freefall mode amidst, likely true, rumors that its portfolio of Swiss franc priced mortgages was annihilated by the depegging announcement. Trust me, this isn't the first casualty we will see, and if supposedly conservative banks were blown up by this historic act of monetary aggression, how do you think more liberal banks fared? Of course, when speaking of Europe, by far the most significant issue today is Greece, which, to repeat, I 17 months ago deemed my, quote, top pick for most likely to catalyze the big one. Regarding Sunday's election, it is simply not possible to underestimate the cataclysmic potential of what Alexis Tsipras' Syriza party will do. I mean, this guy is as anti-establishment as it comes, and at just 40 years old, and refusing to wear a business suit, no less, he clearly could not care less what the rest of Europe thinks. He passionately believes in writing off Greece's debt and perhaps exiting the euro, and the scariest thing is just how much he hates his main negotiating foe, Germany, who he literally considers the enemy. In his first day as Prime Minister-elect, Tsipras demanded the Germans repay Greece for Nazi war crimes, and ominously, to hear his new finance minister speak, it couldn't be more obvious that Tsipras is a demagogic figure with a passionate cult-like following. In other words, I have never been sure that Greece will, for all intents and purposes, secede from Europe, causing massive political, economic, and financial devastation in its wake. And neither are the markets, as Greek stocks have been in free falling for weeks, including 4% today, and shortly will blow through their all-time lows. Meanwhile, the 10-year Greek Treasury yield surged 100 basis points in the past 24 hours to nearly 10%, likely en route to stratospheric levels as the reality of default becomes clearer. To wit, watching what I once deemed the most important stock in the world, the National Bank of Greece, ticker NBG, plunged 15% today to an all-time low, I realized just how close the Greek contagion is to engulfing Europe like Ebola. As it stands, Greece has just 6 weeks or so's worth of cash, so by early March, the real fireworks should start. And this, a Europe at its all-time economic weakest, with political dissension last seen during World War II, historic debt levels, central banks with zero credibility and hideously toxic balance sheets, and as was reported today in France, record unemployment. Heck, the revenge of the people trend I forecast in my 2015 predictions has not only occurred in Greece just 4 weeks in, but just 2 days from now, the Italian presidency succession process will begin, and already it is feared that a Syriza-like movement could wreak havoc. Remember, Beppe Grillo's five-star party has already become the most powerful in Italy, and likely Alexis Tsipras, Grillo is as anti-austerity and anti-euro as they come. And trust me, if Italy starts mobilizing in Greek-like fashion, it will have the economic impact of a nuclear bomb compared to the Greek firecracker we are witnessing today. And by the way, under the where there's smoke, there's fire category, rumors were rampant this morning that the Dutch central bank was buying gold in the open market, aside from the 122 tons they just repatriated from the Fed. When pressed by the media, they denied it, but I'm going to go out on a limb and guess that the truth is not far from the rumor. One day soon, all Western central banks will be desperate to own gold, including the Swiss, but sadly there won't be any to be had. And now for the day's biggest story, as if the aforementioned horrors weren't bad enough, which is the utterly horrifying market plunge today, just one day before the FOMC statement issuance. Frankly, a 290-point stock market decline, and this just days after the ECB's blockbuster hyperinflationary QE announcement, is Janet Yellen's sum of all fears. After all, as discussed in December's 853 Points of Infamy article, and countless others, the powers that be leaves no manipulative stone unturned in its desperate quest to give the Fed, quote, cooperative markets to work with when dispatching its lies, so as to fool the public to believe the Fed is credible. Such operations have always included goosing the stock market and smashing precious metals, and lately demonstrating just how tenuous things have become, goosing oil and interest rates to give the impression of a, quote, strong economy. I'm not going to give the play-by-play of previous, quote, pre-FOMC drifts, as I've done so in great detail in recent audio blogs and articles. However, suffice to say, the, quote, pre-FOMC drift is a real phenomenon, which, believe it or not, demonstrates that over the past 21 years, more than 80% of the equity premium on U.S. stocks has been earned over the 24-hour periods preceding scheduled FOMC announcements. And no, there's no typo there. It's literally been that predictable and that powerful for that long. Moreover, this time around, said drift could not have been more needed, given collapsing global economic activity, imploding currencies, commodities, and of course, crude oil. I mean, just 6 weeks ago, with oil at $59 a barrel, Janet Yellen claimed that the oil plunge and, quote, other factors were, quote, transitory. Well, as I write, oil is at $45 a barrel, and if I had a nickel for each catastrophic other factor that is decidedly not transitory, I'd be quite a rich man. I mean, is the Greek political crisis transitory? Or the horrifying plunge in U.S. economic data, corporate earnings and commodity prices, or the collapse of the euro, or the Ukrainian war and associated Cold War? Thus, I don't even have a lingering doubt that tomorrow afternoon at 2 p.m. Eastern Standard Time, the Yellen reversal will commence. When though new easing measures are not yet likely, no doubt the FOMC statement will discuss significant downside risks to its economic forecast, prompting a rethinking of the rate hike timeline and a heightened awareness that additional loosening, i.e. QE4, would be considered if necessary. Trust me, the words will say something just like that. I mean, this week's pre-FOMC drift manipulations backfired that badly. Following the horrible news from China and Greece, for instance, and ugly corporate earnings and durable goods number this morning, the Dow opened down 375 points, representing its first 2+% decline in nearly a year, albeit just 2.1%. Worse yet, the 10-year Treasury yield was down to a new low for the move at 1.75%, and copper prices were starting to fade yesterday's blatant manipulative goosing. Oil was up from yesterday's new low of $45.03 per barrel, flirting with $46 per barrel when LOL, yet another hope and prayer rumor circulated, this time that the Saudi oil minister was planning to meet with non-OPEC producers like Norway and Finland and Russia. And worse yet, gold jumped $15 an ounce until it was stopped by a prototypical cartel herald at exactly the 10 a.m. key attack time #1, which, how about that, I essentially predicted yesterday in noting the comically suspicious strength of yesterday's mining stocks. Around midday, it couldn't be clearer that the Fed, PPT, and cartel were in full pre-FOMC mode, gradually bringing the Dow and interest rates back up with their prototypical algorithms, walking gold and silver down, and desperately trying to create a significant oil rally. However, even I was shocked to see everything fall apart by day's end, with gold closing near its highs, the Dow down nearly 300 points, the 10-year yield at a paltry 1.81%, and copper down a huge 3% to $2.47 per pound, not only representing a fresh 6-year low, but the second failed goosing in the past week. And as for oil, the diminishing returns of each new bullish rumor cannot be more apparent, as it peaked at $47.50 per barrel following Friday's death of King Abdullah, $47 per barrel following yesterday's comments from the Saudi oil minister that oil could, quote, someday reach $200 a barrel, and following today's Saudi non-OPEC meeting rumor, the highest oil reached was just $46.50 per barrel. Each of the first two times, oil subsequently plunged, and as I finish writing at 8:45 p.m. Eastern Standard Time, oil is sitting at its low of the day at $45.37 per barrel, barely above yesterday's 6-year low close. Do you want to know why I'm so confident that tomorrow will be the big day, even if only an initial Yellen reversal light, in which the FOMC's comments simply acknowledge economic risks without specifically referring to new easing plans? Well, aside from the obvious fact that the global economy is collapsing, along with commodities, crude oil, and currencies, it's the fact that aside from one lame article last week from the Fed's mouthpiece, John Hilsenrath of the Wall Street Journal, in which he weakly stated the Fed's hope of one day raising interest rates, there has not been a peep from the Wall Street MSM propaganda machine about the Fed's likely next step in its supposed plan to first raise rates, albeit patiently, and then exit its toxic balance sheet positions. To me, it's a combination of everyone being too focused on simply navigating the minefield financial markets have now become, and the fact that the illusion the Fed has tried to create of recovery and control is crumbling before its eyes. To wit, I saw an article today titled, "The Central Bank Mirage is Unraveling," in terms of their wisdom, capability, and credibility, and in my mind, no truer words could be said. Let's face it, the end of a horrific era of money printing, debt creation, malinvestment, and speculation is upon us. I fully expect history's largest and most global house of cards to come crashing down in the not-too-distant future, potentially by year-end. And tomorrow's long-awaited, inevitable Yellen reversal, be it mild or full-blown, will represent the beginning of the end, which I assure you won't be lost on former MSM lackeys that have already started jumping ship. It won't be long before the entire world realizes that scheme cooked up in early 2013 to convince the world the Fed was in control was nothing more than that, a scheme, or better put, a scam. Thus, if you think the powers that be have lost control of markets like commodities and currencies, just wait until they lose control of precious metals, equities, and everything else. In the aftermath will be an extremely scary world, and thus I cannot more urgently warn you to protect yourself and do it now. And for those that decide to take action by buying or storing precious metals, we hope you call Miles Franklin at 800-822-8080